Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Alasdair Macleod of the MacleodFinance Substack. Alasdair, how are you?
I'm very well. Thank you for having me on, Robert.
Really looking forward to this, and I thought that silver might be a good place to start today in our conversation because there is this growing movement to do with silver squeezing on Monday, the 31st of March. Just wanted to know if you had any thoughts or opinions on that, and maybe what's caused people to rally to create such a thing in the first place.
Yeah, I mean, I've heard about this sort of squeeze and all the rest of it, and I understand that silver is in backwardation on the LBMA, but I think it's not too surprising in the sense that silver has always been in short supply. I mean, there's always been the sort of drawdown, if you like, on investment silver, as the Silver Institute would call it, whether it's ETFs or whether it's, stocks owned by investors. In other words, what they're looking at is vaulted silver. Um, I mean, what's happened, which I find fascinating, it's with both gold and silver, global liquidity has just been drained out from everywhere in a rush to move everything into the COMEX warehouses. And so the idea that you got the end of this March contract coming up in the futures, you've also got um, uh, settlements on the LBMA, which we don't know, which because they just don't release that information. But it's bound to be so incredibly squeezy. Anything outside COMEX, has disappeared. There's no liquidity left. So, and the big difference between gold and silver is that in gold, you can go along to the Bank of England and say, please, can you arrange a lease for me because I'm short of stock, or, because I just want it, or I like the color of the stuff, or whatever. So you can go along to the Bank of England and arrange a lease for gold. But you can't go to the Bank of England and say, I want to lease some silver. They'll say I'm sorry, you got the wrong department. So um, this is the interesting thing. Now, silver has been sat on, let's face it, been sat on and sat on and sat on,
Mhm.
which has to be the case if, according to the Silver Institute's figures, apart from some sales of ETFs about 5, 6 years ago, it's been in supply deficit for 7 years. 7 years. I mean, it's a hell of a long time. And we're talking about probably the most useful metal in the world when it comes to electronics in particular. Whether you're talking about photovoltaic cells or whether you're talking about military applications or whatever. It is, if you like, I think, just desperately important. And to have a gold silver ratio in excess of 90, which it was this morning, is just nuts. I mean, there's no other description for it. So I think it's fascinating. And today, we're running up into the. I think it's tomorrow. We've got the last day of trading for the current series of options, the April
Oh.
contract options on COMEX. Now, normally what happens is that the swaps who are short will engineer, let's put it that way. I mean, whether they do it as a cohort or whether they do it quite independently of each other, you know, we will not discuss. But they get the price down. They trigger swaps on the longs and all the rest of it. And hey, presto, you find that silver is, say, under 32, gold is under 3,000, and something like 6,000 contracts of gold, and I don't know how many, future options contracts of gold, and something, I don't know what the number is in silver. I haven't looked. Are suddenly out of the money and expire
Mm.
worthless. And guess who likes it? The swaps who engineered and the shorts who engineered the fall. I mean, great stuff. Love it, love it. But it's not happening. Why? And this is the fascinating thing. What's happening, I think, is the squeeze is on the shorts. This is not a regular bull market in the sense that people are going in and buying stuff.
Mm.
And this is certainly not true of silver, and it's certainly not true of gold. It is a squeeze. And the amazing thing is that the markets are so short of physical that squeeze is happening in the case of gold at all-time highs. In the case of silver, I mean, because it's spiked up in the past to $50 or whatever, you can't claim that. But you can see, if you just look at the chart, and you can see, if this exceeds 34, $35, then there's nothing to stop silver going to the moon. Now, it's not just idiots like me that know this. It's the swaps who read the charts and they look at it and they think, I'm sure this is not good. I'm going to have to close my position. What do I do? How do I get out of it? So you can see where the problem is. So, I mean, this comment about 31st of March, yeah, we're coming up to the end of the month. Once the end of the month is out of the way, the April contract will be out of the way on COMEX, and also the options on the contracts. And presumably, there is a similar situation brewing on the LBMA because, as I understand it, there is a small backwardation on silver, which just tells you that for very short time delivery, near deliveries, they're short of stock compared with maybe going out a bit. And going out a bit is, well, the position will whistle for it, if you like. So the answer to your question is, I think this is a very, very interesting week, actually. And as we run into next week and the beginning of April, I mean, this market feels so good. It really does. I mean, I just get the feeling that this isn't going down. This isn't going to go down. This is going to rise, and it's just a question of when and how much, not if. This is feeling really, really good.
It certainly is. And just to date stamp things, we're recording this on the 25th. So the options expiry is on the 26th. Podcast is out on the
26, correct.
27th. So hopefully by the time this podcast comes out, there'll be a bit of a clearer lay
Hopefully
of the
we'll be
land.
proved right.
Fingers crossed. That's the idea. I think what fascinated me about the Silver Squeeze group, and I'm not going to throw people under the bus here, is that there was a lot of, oh, everyone's got to do their bit, buy some physical silver, etc. And I hit back at a couple of people and said, "Look, I understand that, but also remember why, or give a reason why you should do it, not just to
Hmm.
try and get on the other side. Obviously, I'm not here to offer investment advice. That's not my job. But just looking at a simple chart going, look at what silver's all-time high is, 1980, 81, around $50, call it. Look at where it is now. And even if you just do it based on that fundamental opportunity, that's probably a good thing as well. So I think we're in interesting times.
Yeah, absolutely. So, we will watch events unfold over the coming days.
Yes, we definitely will. Moving on to gold, you wrote in a recent article that gold is or has the potential to start acting or it might be acting like a Giffin Good. So could you explain what the Giffin rule is and put a bit more meat on the bones to that, if you don't mind, please?
Yeah, it's the sort of thing when, I mean, a normal sort of relationship between supply and demand. If, let us say, there's a shortage of supply relative to demand, then the price rises, and it rises to a point where, in theory, supply is triggered, and you get a balance between supply and demand. That's is basic market theory, which is fine. But there are some goods which behave perversely. When you get a rising price, it raises demand and
Mhm.
quashes supply, so that the whole thing sort of goes, it feeds on itself, as it were. That is, if you like, um, what happens to a Giffin Good. I mean, that is the description, if you like, of the price movement of a Giffin Good. And I think in the case of gold, I mean, normally this is sort of for low price things. I mean, there's literally small, things which are not priced very highly, and therefore, people don't sort of think, well, I'm going to sell this if it goes up. I mean, so these are, for example, consumer goods. Something like loaves of bread. If there's a run on bread or toilet rolls or something, you find that the run creates its own demand, sort of thing. So that's a Giffin Good. Now, in the case of gold, I think we're seeing something similar, which is very, very unusual. I would say that you've got a number of factors that have come together. The obvious one over a long term is that the Asians have been accumulating gold. We know that China has been accumulating gold, both as a state, and I'm not talking about what's only in the PBOC's official reserves, but also the huge amounts of gold, which undoubtedly have been stored by the PBOC on behalf of various government agencies.
Hmm.
I calculated that by 2002, this figure could well have been close to 20,000 tons. And bear in mind that that was accumulating it in a bear market. And what the Bank of China would be doing is just letting the stock come to them, as it were. It's a sensible thing to do. Um, and then, of course, in 2002, they set up the Shanghai Gold Exchange, and they even advertised to people, say, now you can buy gold, go out and buy it, as it were. They were television adverts, apparently. And so they've now accumulated, I mean, on the basis of what's been withdrawn from the Shanghai Gold Exchange vaults, you're looking at something like 25, 26,000 tons. So, I mean, this has placed a huge, great strain on Western sources. And literally only today or yesterday, various insurance companies have started buying gold and have
Hmm.
become members of the Shanghai Gold Exchange. This is meant to be a pilot project, but it couldn't happen at a worse time as far as we're concerned in the West, with rather limited supplies. Furthermore, people behave like investors. I should say that the point about gold is that gold is money and all the rest is credit. It's not gold going up, it's credit going down. So this is not an investment, okay? That's it is money. That's a key point. But when people rush out and buy ETFs, they're treating it like an investment. And you wouldn't believe the number of people who say to me, well, what proportion of my portfolio should be in gold? You know, they're talking investment philosophy, if you like, or, investment. So they go into ETFs and they see, here we are coming to the end of Q1 2025. And guess what the best performing asset class is in the whole investment universe? It is precious metals,
Hmm.
gold, silver. And if you're a portfolio manager, then what the hell do you do? I mean, your Magnificent Seven, the Tesla down 40%, Nvidia down, I don't know, similar, I mean, that's killing you. That's absolutely killing your performance. What do you do? End of Q1, when you're going to report to the poor punters whose money you manage, you
Hmm.
think, well, God, I've got to get something in here which looks at least sexy, to detract from the rubbish which is killing me. So yeah, they go out and they buy gold ETFs. They might even buy silver ETFs. I don't know. But anyway, we'll just concentrate on gold for the purpose of this argument. So this is now creating yet more of a shortage. And then guess what? You get, Donald Trump says we're going to tariff absolutely everything. And there is a fear factor coming into this from COMEX. You find that the swaps have got to try and close down as much as they can. They've got to get physical metal in. So suddenly they engineer huge, great premiums on
Hmm.
both in gold and silver futures. Now, the reason they've got this problem is because of stands for delivery. These stands for delivery have been escalating. Now, over the last 4 years, I calculated the stands for delivery was something like 2,100 tons. That was the last 4 years to 2024. Now, in this year, the stands for delivery have accelerated at almost 4 times the pace that we've seen in recent years. Now, the idea that of a stand for delivery is actually being delivered is, not quite true. If you want to actually take delivery, you've stood for delivery. You are entitled to that delivery, but do you get that delivery? No, you don't. What happens is you get prevarication and prevarication and prevarication. So the result is that there is a huge backlog of stands for delivery that haven't been delivered. Now, you're a major bullion bank operating in COMEX. You have promised these guys who stood for delivery against you, don't worry, you'll get it one day, whatever. I mean, whatever story you say. Or here's a piece of paper that says, we're holding it for you. But they haven't got it. So what do? They have to ramp up the price in order to get it in. Why do they do it right now? Because if they don't do it now and tariffs are put on gold, I mean, they're going to get crucified by 25%. So, and the effect of this has been to drain all liquidity out
Mhm.
of everywhere in the world as it all floods into COMEX. And the levels of stock in COMEX warehouses for both gold and silver are now at all-time records. I mean, this is huge. It really is huge. So we're talking about Giffin Good. You can see that there are a number of factors that suddenly have come together to panic people into buying it because they haven't bought it, they haven't got it. And the higher it goes, the more they're going to be panicked. And I think that what we've seen in the markets just ahead of the expiry of the April futures contract and the options does rather confirm that once this little hump is out of the way, in fact, I don't even wait for this little hump to be out of the way. I mean, basically, it looks like these precious metals are going to go a lot firmer. But of course, we must bear in mind that it's not precious metals going up, it's currencies going down. Having said that, there's a bit of this and a bit of that, if you like, in the equation. At the moment, it's a bit of a panic into the precious metals, but the implications for the future purchasing power of dollars, pounds, euros, yen, whatever, actually doesn't really bear thinking about because they're credit, gold is money.
And I think I mentioned off air that I'd scribbled some questions down, and that was one of them because I know that, again, through your writings and listening to you for a long time, it's gold is money, everything else is credit. And I had Egon von Greyers on the podcast the other week, and he said very similar thing. It's not that gold is going up; it's everything else is going down. So again, I appreciate that most people listening to this will understand that, but there's probably going to be people that is a new concept to them. Could you go into that in a bit more detail, just so we
Yeah,
can
sure,
lay
sure.
it out?
Yeah, I mean, if you read Roman history, there's an emperor called Diocletian around about 300 AD or CE, they call it now. Sorry, I'm just going to stick with AD. Now, he had a little bit of an inflation problem, as we would put it. Prices were rising, and the people were getting a bit fractious about it, and all the rest of it. So he produced an Edict of Maximum Prices. And that is fascinating because if you look at the maximum prices in his edict, apart from the slave markets, which have closed, and we can't really have any comparison on that, you can see that for fairly normal everyday goods, whether it's food or whether it's clothing or whatever, the prices then are similar, measured in gold, to what they are today. It's not that different. So, in other words, gold holds its purchasing power over the centuries and even over the millennia, because I mean, Diocletian was what 1700 years ago. I mean, we're talking long spans of time. Um, and of course, I mean, the reason that this is the case is that the amount of above ground gold seems to expand at roughly the same rate as the global population. So, you've got this factor. Now, there is something which also needs explaining, and that is the role of credit. Gold is never, well, hardly ever used in transactions. It is used, if you like, as a backstop to the value for credit. So it's all very well me saying that, the gold has expanded at the same rate roughly as the global population. But of course, transactions, if you like, have expanded at a far faster pace.
Mhm.
So how can that be? The answer is that the transactions are all in credit. In other words, if you take a currency and you say, I will make this currency exchangeable into gold coin at a fixed rate at the holder's option, then you've got a proper gold standard. And the currency doesn't become gold, it becomes a gold substitute. Yeah. So you can expand that, reasonably significantly without affecting prices. I mean, it comes to a point where if the expansion is into non-productive uses, then you will find that you start losing gold, if you like, your gold reserves, which you have available to exchange for the currency. So that's basically the setup that we had in the UK between about 1820 and 1914. And if you look at prices, I mean, particularly from the time of the Bank Charter Act in 1844 to the turn of the century, 1900, in other words, a period of, well, let's call it 60 years, wholesale prices, the wholesale price index was exactly the same, unchanged. A little bit of variation. There was earlier variation, but that was because the banking system, credit markets, if you like, were gradually perfected from, going back actually into the sort of before the Napoleonic Wars, but particularly following the introduction of the gold standard, there was some considerable variation in prices in the early days. But remember, we had at the end of the Napoleonic Wars, you had returning troops. There was no welfare or anything like that. I mean, call it a depression if you like. Prices fell. You had various other things happening, like changes in the corn laws and all this sort of stuff, which affected prices. But principally, the credit system just became better and better and better over time. You find that banks, could clear with each other. And instead of having to send messengers round and clear each deal and all the rest of it, or imbalance, they produced a central clearing hub for the London private banks. And the Bank of England only joined that in 1867. And so you can see that, that was what happened. Now, between 1844 and 1900, the quantity of gold in the Bank of England's vaults didn't alter that much. I mean, there were times when there was a bit of a crisis. Yeah. And they learned lessons from that, or we did. We have lessons today from that. Okay. But if you looked at the expansion of credit expanded 12 times. If you like, money supply in our terms expanded 12 times. So, and what happened to prices? Nothing. So, the point behind this is that you have to anchor the value of credit to gold. Gold is the constant, okay? It's the credit which, if you've got rising prices, it's because the purchasing power of your credit is going down. Now, that can't really happen if it is properly tied to gold. What happens is you start losing gold reserves. And the way in which you deal with that is you have to raise interest rates to the point where the gold no longer flows out of the country. That is the real purpose for interest rate management in a central bank. It is to manage the gold reserves. It is not to try and manage the economy. Big, big mistake we all make today. And this is something which has got to change. But getting back to your point, I mean, this is the level prices are provided by gold as money because it is not credit. Everything we deal with is done in credit, and its value must be attached to gold. If it's not attached to gold, then it goes down. And to give you an example, in the UK, I mean, the sovereign, which as late as 1932 you could exchange one sovereign for £1, is now, 560? Pounds for each sovereign, which gives you an idea of the debasement of the currency. That's what's going on. It's not gold rising, it's currency going through the floor. And when everybody realizes this, or when the majority of people who use the currency realize this, they wake up to it, then the currency is doomed. I mean, it's as simple as that. And I mean, we saw this in Germany in the 20s.
Mm.
And the people who really analyzed it at the time reckoned that it took something like 6 months. And people beginning to realize that it was the currency going down. That was when they were just getting rid of it as quickly as possible for goods. Crack up boom, as Ludwig von Mises described it. Um, it takes 6 months and that's it. And it could happen actually a lot more quickly for various reasons, which to do with the credit bubble, which is the largest
Mhm.
we've ever seen. And if your viewers don't understand that we're in a credit bubble, they're sure to understand we're in a debt bubble. And credit is just the other side of debt. Credit equals debt. It's quite simple. It's the other side of it. You owe me something. I have the credit. I have value in that credit because you owe it to me. So credit equals debt. We all know we're in a debt bubble, but we don't seem to understand we're in a credit bubble. And to top it all, President Trump is pushing for tariffs. Um, and it's exactly the same condition that we had, but potentially more violent financially. In 1929 to 1932, we had the end of the Roaring Twenties, which was a credit bubble, and then we had the Smoot-Hawley Tariff Act, which was introduced in 1930. We got the same thing happening today, yet so few people seem to realize it. So spread the word.
I yeah, I agree, and that was part of doing this podcast, and that's one of the reasons I enjoy having these conversations. It's to spread that knowledge, spread that awareness, and to get more people listening and or watching if you're watching this on YouTube, and to then take action based on what they've heard. And I think that's important. Normally, this would be the point where normally we go back to Trump USA and gold hitting $3,000 and all that sort of stuff. But because I think people have detected we're both from the UK, let's look at what's happening then in the UK. Because whenever I look at the news at the moment, it's all doom and gloom. It's all socio-economic at the moment, so that's not good. But I picked up on a story the other day that the government spending in February was up by just the 4 billion. I mean, that's not healthy. That's not sustainable. Um, what, what's going on in the UK financially? What sort of position are we in, or are we just a little tiny dot in comparison to the bigger players on the global stage?
Well, it's a bit of the latter, I think, in a sense, but both. I mean, the reason the dollar is so important is it is the reserve currency.
Mm.
It is globally owned. Anyone who's doing international trade needs to have dollars to settle transactions, whether they're buying raw materials or whether they're buying semi-manufactureds or just exporting consumer goods or importing them. You need dollars, dollars, dollars. And so the dollar debt situation is of paramount importance to the world, not just America, but to the world. Within that context, I think sterling is important in a European uh, um, uh, uh, context, as it were, because we are the center in London. We are the center, if you like, for Europe. So sterling is exposed to foreign ownership. So what happens here actually could have a huge, great bearing on the currency. Now, the reason that the currency hasn't fallen, I mean, we've got a socialist government which is producing, schoolroom socialist ideas or the ideas of the 1930s, as if nothing had ever happened. The collapse of communism, which disproved all their theories and all the rest of it, they've ignored it completely. And they're just pursuing exactly the same thing. Trade unionism, big state, and everybody really should be employed by the state. I mean, that's roughly where they reckon that ideologically they're going. They won't get there, of course, but anyway, you can see that under those circumstances, anyone who is rational would sell sterling. But going back to what I was saying about managing gold reserves, the reason that sterling has not collapsed is because the interest rates are held at a high level, and the Bank of England has been reluctant to reduce them. On top of that, you have got a higher yield along the yield curve for gilts than US Treasuries. So, the idea, if you're going to sell sterling for dollars, and the two, it's a sort of, I mean, there are other currencies, but if you're going to trade currencies, you might be looking at sterling. If you're in sterling, your alternative is most likely to be dollars. So are you going to take a lower, do you see what I mean? So if you go out of
Yeah.
sterling, you've got to accept a penalty. And that's the only thing keeping it up. Now, tomorrow we've got, she's laughingly called Rachel from accounts, um, trying to remedy a lot of the problems she caused in her first budget. Um, but I mean, I'm afraid that the global scene is not good. That does undermine her position. As well as that, I mean, the consequences of what she produced in her first budget has made an economy which was really getting into trouble somewhat worse. And I mean, we've got a banking system which is so unhelpful to small and medium sized businesses, which are 80% of the economy, by the way. And so I think we're likely to have rising unemployment. I think we're going to be pushed into a deep recession. I mean, I think slump is a better word. And so tax income is going to go down, welfare costs are going to rise. So what's going to happen to Rachel's budget balance? It's going to deteriorate big time. And all she can do is fire some civil servants. That's not where the problem is. The problem really is with total government spending. You can save a bit on salaries, but that's not much. It really is not much. And of course, she's comes from a party which, she's not going to get the backing for her cuts in the parliamentary party. That is for sure. So, yeah, it's going to be interesting. She's due to stand up tomorrow and tell us our fate. So but I do think that the situation here is going to deteriorate really quite significantly, and under those circumstances, I would not be a long-term bull of sterling.
Like that's fair enough and completely understandable because there's that element of not trying to come across as being too doom and gloom, but at the same time, I always like to say these are realistic conversations. All we've got to do is look at the numbers, look at the data, look at what's happened before, look at what's likely coming down the road, and everything you said, they're sentiments that I would agree with, and I guess in terms of providing solutions and so forth, we've touched on it already. Is if people have not got any positions in, physical gold, for example, again, I would urge that you go and do some research, do some homework, and then look to possibly take a position because, as you said, it's not that gold is going up in price. It's working in the other direction. It's the credit, and if we've got credit issues, which we have, then the more people that are aware of that, the more people we can help to help themselves protect themselves, if that makes sense.
Yeah, absolutely. No, I'd agree, and that's very much my mission at MacLeod Finance, to try and educate as many people as possible about these dangers, because they do need to protect themselves, and to protect themselves, they need to get out of as much credit as they possibly can. They won't do it. They'll do it perhaps half-heartedly, but what the heck? At least they will know when it all goes wrong. They will know why it has gone wrong. Um, we can't do much better than that. Anyway, I think it is desperately important to get this message out.
Yeah, I completely agree. What I'll do on the Substack post that comes with the podcast is I'll link to Diocletian's edicts because yeah, they're fascinating. They really are. If you've not seen or heard of that before, I'd recommend you go and check that out because that is really fascinating. Um, the the other topic that does come up every now and then is miners. And again, I was reading through one of your articles earlier on, and this number took me by surprise. So I'm just going to quote. I'm just going to quote it as I see it. It says, as a proportion of the MSCI's $217.1 trillion value of US and other developed nation portfolios, the entire gold mining universe represents only 0.21% of that total. I find that number absolutely staggeringly low. Um,
It is. It is.
yeah, the mind boggles. The point
Yeah.
I think on that I would make is that although gold and silver is waking up and waking up for good reason, it certainly seems that the miners are doing the same thing as well.
Yeah.
Why is that percentage so low? Is that because people are so focused on the equity markets and have not really been paying much attention to gold, silver, and the miners?
Yeah, it's basically that. I mean, it's that plus the commodity cycle, if you like, has not been conducive to encouraging investors to, invest in commodity stocks. But on top of that, the feature of a credit bubble is that you get the fashionable stuff like tech stocks and financials and so on and so forth being chased for their momentum rather than their value. And of course, all the research effort in the broking houses goes towards getting business in those areas because that's where the business is. The result is they have underinvested in mining research and commodity research generally. So, we have the situation where because nobody is promoting gold mines, gold exploration stocks, whatever, or hasn't been, they're just completely neglected. So there's a combination of those things. But I mean, the thing that's fascinating about that figure of 0.2 something percent is it just shows that all you need to do is get a small shift, if you like, in
Hmm.
sort of portfolio allocations to really change the landscape as far as mines are concerned. And at the moment, I mean, if you look at the ones that are performing, I think mainly they're the sort of establishment figures. I don't follow the sector in detail, so I'm not going to mention individual stocks. But a lot of the exploration stocks haven't moved at all. And this is important because if you can do your research in that area, some of the exploration stocks will be the target, if you like, of corporate finance
Mhm.
takeover deals, whatever, because as the price of gold, as the price of silver, as the price of copper incidentally is performing pretty well. That's hitting new highs too. You can see that these projects which might have been valued or ignored or whatever suddenly have some sort of value, and the big boys don't really have any major projects on hand. So, they're going to have to scrabble around. It's always happens, actually. They use the exploration companies as a sort of information feed. And when the time is right and it looks like the exploration company is actually onto something, bingo, they go in and buy it. So, this corporate activity, I think, is going to be a feature of the next year, and quite significantly. Always happens. So that I think is interesting. The other thing I would say as a background is that in the context of a currency collapse, and particularly with the collapse in the stock market, those Magnificent Seven, Bitcoin even, which correlates with them, believe it or not, and the sort of financials, as they go down the tubes, there's going to be a huge, great problem because they represent a lot of collateral for the banking system. I mean, margin loans are over $900 billion in the US, and that's just one portion of it. The other thing is that as the dollar goes down, for the reasons we've discussed, interest rates are going to go up. And as interest rates go up, you're going to have more banks getting into difficulties and having to be rescued. And what's that going to do? Well, it's going to lead to the debasement of the currency even more as the Fed goes out and tries to rescue them. So you can see that this is a situation which, taken to its logical extent, could actually wipe out the value of all credit. And so if you've got shares in something, I mean, you could find that the shares in XYZ mining company could rise 50, 60, or 100 times, but the dollar has gone down to 1,000th of it where it was when you bought the share. So you can see that this is quite a difficult thing. But I think there's one aspect of this which gives me great hope for the mining sector, and that is Russia, China, and the BRICS. Over 70% of the world's population are in that camp, and as well as the Shanghai Cooperation Organization, incidentally. Over 70% of the world's population in that camp. And it's that population which is rapidly industrializing. They need these raw materials.
Mhm.
China and Russia, as the two hegemons who run the circus, have gold. They have bought gold. They have it there to defend their currencies. They will go on to gold standards. I don't know that they will do it properly, but they will go on to some form of gold standard at some stage to ensure that their currencies don't go down along with the dollar, sterling, euros, yen. So on that basis, we've got this alternative world, as it were, to ours. Western world, the advanced economies, advanced and declining economies. We've got this new world, which is actually like a phoenix rising from
Mm.
nowhere. And this is good stuff because it does mean that the output from mines, copper mines, so on and so forth, is going to find demand. So that's good news. That is very good news, and I think it just adds to the attractions of the overall commodity sector.
I think that's a good place to, it's always nice to finish on a positive note. So I think that's a really good place to finish off that conversation. And that there's always potential, there's always opportunity. And as we've said multiple times in this podcast episode, that if you don't have a position in physical gold or silver, whatever, then do your homework, do your research, understand why it's a very good thing, and obviously make a decision that works for you. I'm not a financial advisor, so don't take that as a financial recommendation. But given everything we've discussed, I would say it's highly prudent that you look at doing that. Uh, I would urge people, obviously, to head over to alistairmacleod.substack.com, the MacLeod Finance Substack. Again, I'll put those links into the show notes. Also on
Thank you.
X as well at MacLeod Finance. Any other places that people can get hold of you, and any other last words of wisdom at all for today, Alistair?
Well, those are the principal places where you'll get my stuff. And I do lots of interviews like this as all part of spreading the word. So, I mean, even if you're a free subscriber, most of these will go up on, depending on schedules, will go up on, available to free subscribers. But if you really want to, sort of learn about this, how to protect yourself, if you like, in these very difficult times and understand what is going on, then there is the option to become a paid subscriber, and then you'll get the whole thing. And it's not expensive. I mean, it's a couple of cups of Starbucks a month, if you like. So, and that I don't think is damaging to anyone's budget, really. So, that's really where I'm really concentrating, on my efforts. And of course, when it comes to interviews, it's not just me putting them out on mine. I mean, you'll be putting it out through your
Yeah.
media channels, and so does everybody else who interviews me. So, and if you just Google MacLeod Finance or Google Alasdair Macleod, and you'll come up with a huge number of links, which hopefully are me rather than anyone else.
That's no, that's absolutely brilliant. And as I mentioned, I'll put every link I can into the Substack post that comes with the podcast. Or if you're watching this on YouTube, again, just look in the description. Everything will be on there as well. Alistair, well, thank you for your time. I think it would be prudent to possibly catch up towards the back end of 2025 and have a look at the lay of the land then, if that's okay with you.
Yeah, absolutely. I look forward to it. Thank you for having me on.